So I'm curious, do you think retail is going to come back into crypto?
Probably not. I think retail may in fact be gone for a little while as the primary driver of this market. But like we think Bitcoin can get to $1.4 million in the next 10 years. The next 5 to 10 years, there's an easy 10x in crypto. Sui was down 70% in 2025. Aptos was down a similar amount. And it made me think, why is this? And there was a simple answer to that. Do I worry about Bitcoin being broken by quantum? No. Do I think quantum will sort of detract from the long-term trajectory of Bitcoin and Bitcoin going to, $1.5 million a coin in the next 10 years?
So of these four signals, which one do you think actually matters most for breaking the bear market and why?
I would say I think that's maybe the trifecta that pulls us out of it.
How would you think about structuring a portfolio?
Can I give you 3 different views?
GM everyone, and welcome back to another podcast episode here on the Coin Bureau. Now, today our guest is Matt Hougan. He is the CIO of Bitwise Asset Management, one of the most well-known crypto asset managers and ETF providers. So, Matt, a very warm welcome to the Coin Bureau.
Oh, thanks for having me. I'm so excited to be here.
Pleasure having you, and we can't wait to dive in. But before we do, guys, just a quick disclaimer. Nothing in this episode is financial or investment advice, so please consult the disclaimer in the description for more information, and then afterward, consult your financial advisor for more investment before making investment decisions. Now, Matt, I think it's safe to say that things haven't exactly gone as we expected over the past few months, indeed the past year. It's been a brutal past few months. First, we had October 10th, and more recently, of the 5th of February, when Bitcoin fell to 60K. But more recently, actually, you released a thesis that we've actually been in a crypto winter since at least January last year, which is definitely a unique take. And you kind of called it like a masked winter. So can you explain that a bit more?
Yeah, absolutely. That's what we see in the data. I came to this conclusion because I was looking at a chart of the 10 largest crypto assets starting in January 2025. And what you saw is that the big guys, Bitcoin, Ethereum, and to a smaller extent, XRP, did pretty well in 2025. I think Bitcoin was down 6% or so. But everything else just got crushed, right? Sui was down 70% in 2025. Aptos was down a similar amount. All of the non-Bitcoin ETH XRP coins were down between 40 and 70% in 2025 before we got to the pullback this year. And it made me think, why is this? And there was a simple answer to that, which is if you looked at Bitcoin and ETH in particular, institutional investors were shoveling money into those assets. There was about 75 billion in flows into Bitcoin and ETH ETFs and DATs in 2025. And that was keeping the price up, masking the winner, as you said. But beneath the surface, retail investors, traditional crypto, they were selling everything. They were selling Bitcoin, they were selling ETH, they were selling Sui, they were selling Aptos, they were selling Solana, they were selling Chainlink. It was just in Bitcoin and ETH, you had institutions papering over those losses. So my thesis was crypto natives entered the winter in January of 2025 when Trump was elected. They're, 13, 14 months into the winter. And it lines up with what you see in the data. When you look at the crypto fear and greed index, we're not at the beginning of a winter. We're in the deep freeze, right? What did that number get down to? I think 5, the lowest all time. So yeah, that's the thesis. Institutions were moving on a different time scale. They were bullish until October. They've now been shaken out. You're now seeing outflows even from ETFs. They're not huge, but there are some. But crypto retail has been a deep, dark winter ever since Trump got elected. And for that reason, I think we may be getting toward the end of that winter. We can start talking about the spring coming a little earlier than maybe most people expect.
That's interesting. So yeah, retail itself kind of like then tapped out early last year after Trump's election victory. We saw that with, and so you think that, let's assume the max euphoria in terms of the blow off top was when Sol rallied after the launch of the meme coin. And then ever since then, retail's basically like either been cashing out or, retail may have been coming in through the ETFs, but that's obviously masked any sort of spot flow. And then the institutions started buying in. And that's interesting to the extent, though, because with the Solana ETFs only really started coming out towards the end of last year, right? So that therefore, that's why we saw Bitcoin and ETH start rallying middle of last year off of the institutional demand for these ETFs. Then
that's exactly right. And you saw those ETFs that sort of saw those crypto assets that got ETFs in the middle of the year, like Solana, even like Litecoin. They did okay. They were down 30, 40. It was the assets with no ETFs that were down 70. The thought experiment was, imagine we didn't have ETFs. Imagine institutions were still on the sidelines the way they were in, let's say, 2020 or 2021. It would have been a brutal year in 2025, right? We would have been minus 60 on everything. It was just these ETFs that kept us afloat, and only for ETF linked assets. That's what we see when we look at the data.
Okay, makes sense. So if these institutional ETFs masked the bear market by absorbing the selling pressure throughout 2025, what happens if those same institutions decide to rebalance away from crypto now in 2026? So potentially, are we at risk of a delayed vertical crash once the ETF wall is no longer buying?
That's definitely a risk. If you saw a large scale movement out of these ETFs by the institutions who bought them, yeah, you could get a second leg down. And I don't think we can write off that probability. I will say that's not my base case. What we've seen so far in the data is that the ETF buyers are actually pretty much diamond hands, right? About $60 billion flowed in before 10/10. And since then, only about $7 billion has flowed out, even though prices are down 50% plus. The reason for that, for what it's worth, based on the conversations we have with financial advisors and family offices and other institutions, is that even though crypto is starting to go mainstream, it's still a little bit risky to buy, right? If you're at a bank or a brokerage or like an insurance companies and you say, I want to buy Bitcoin, you're still sticking your neck out. And as a result, those buyers have been very high conviction buyers. That's why we haven't seen a lot of money flow out, because they were really high conviction in order to do it in the first place. But if there's a sustained bear market and institutions lose faith and we see 30, $40 billion flow out of Bitcoin and ETH ETFs, yeah, that'll contribute to, I think, another leg down. That's definitely a possibility. It's not my base case, but it could happen for sure.
I'd just like to get some perspective from you on this then, because you obviously speak to these institutions who are considering adding Bitcoin to their portfolios, albeit through the ETF front. And how much of their allocation is based off the fact, because you obviously know how TradFi usually works in terms of how asset managers think about allocation to asset classes. Generally, there's many different factors they think about. So one could be like, okay, we want a debasement hedge against the de-dollarization and inflation, and Bitcoin is this asset class on a fundamental level. But then also they think about momentum as a factor, right? So price action, and that's obviously price action begets more price action because people want to buy in when an asset is rallying. But these investment managers think about it, okay, Bitcoin was underperforming last year, right? It was down on the year when many other assets were up. When they speak to you about this and they speak about actually investing in Bitcoin and adding it as an asset allocation, how much of the price action itself and the concerns around the lack of momentum in the price action over the past few months is a factor in their thinking?
Yeah, it's a great question. It actually breaks down into two groups, in my experience, from being out in the field. The people who bought it last year and are down are worried enough about the price action that they're not buying more. So they're not selling, but they're not buying more at this point. But the vast majority of institutions are still at zero. And to be honest, I know this sounds just too bullish, but it is true. When you go and speak to these institutions, they see it as more an opportunity and a risk. They're not shocked that Bitcoin is volatile, right? They're not shocked that it has these 40, 50% drawbacks. By and large, if they're at $0 invested, they're looking at it and they're thinking this is an attractive entry point. That's hard for us in crypto to imagine because we're so emotionally connected to our Bitcoin, but put it in like an AI format or a format outside of the crypto world. If you had the leading AI companies, the private companies, the open AIs, the Anthropics, and their prices on the private market fell in half, would you think like, oh, these guys are doomed? Or would you think, maybe this is an interesting entry point? I think that's how advisors are thinking about Bitcoin, Ethereum, assets linked to stablecoins and tokenization. They're like, yeah, it's volatile. I'm not surprised. If they haven't bought already, they think this is a pretty good point to get in, and I think they're actually right.
Yeah, it's a good point. Definitely, from a fundamental perspective, for sure, Bitcoin is underpriced from through many metrics. I'm just curious though, because in terms of, I'm sure you've seen the chart on Twitter around the performance of all other asset classes and Bitcoin post 1010, and you've mentioned this as well. And there's this sense that many people get that something kind of broke on that day, where there was this just massive divergence with all other asset classes. And it speaks to this question of whether there is something fundamentally that is, kind of broken in the crypto markets to the extent that, all these rallies get sold very quickly and that their liquidity is thinner, much thinner now these days. And there's a lot of conspiracy theories out there as well. So I'm curious, for someone who's deeply involved in the industry, do you have a sense of what you think could have happened? And is it something that is stuck around for so long that it's still impacting on the market?
Yeah, I think it's multi-factor. So I think there are a lot of factors that contribute to that. The biggest one was people selling ahead of the 4-year cycle. I think that's a reflexive determination of price, right? People were worried about a big pullback in 2026. So when they got the signal to sell, which 1010 was like a blinking signal that there's risk in the market, they started to sell. And I think that drove the price down. So that's a self-fulfilling prophecy. It's unique to Bitcoin. I think that's one of the reasons it detached. But there's some other factors as well. I think the rise of quantum risk is very real. I think usually the sort of OGs who would step in and buy Bitcoin in deep, dark pullbacks are worried about quantum risk. They want to see that addressed. And so there hasn't been as much of a cushion from those buyers as there has been in the past. I think people are incorrectly worried about Kevin Warsh being more hawkish as the new Fed chair than I think he will really be. I think people, generally speaking, have that wrong. There's been a general deleveraging, and there's been a loss of the attention investor who buoyed crypto markets for so long, because the attention investor has pivoted to gold and precious metals and AI, right? The Robinhood investor, the person getting financial advice on TikTok, is getting less financial advice about crypto and more about AI and precious metals. And I think when you put all those factors together, led again by the fear of the 4-year cycle, but with quantum, with Kevin Warsh, with AI detracting investors, you get an explanation for this pullback. But you don't have to dig that deep into it, right? This is a classic crypto winner. This is a classic repeat of the 4-year cycle. I don't like it. I don't think the 4-year cycle should exist, but you have to look at it for what it is. It's right there in front of you. It's not that surprising, honestly, that we're down.
Yeah, we'll get onto all of those points in a bit in terms of potential factors. But just curious, then, just going back to the original question, so you don't think there was anything that particularly happened in that event in terms of market microstructure that had a sort of long-lasting impact on the Bitcoin markets and in crypto in general? Because I don't know, I just get that sense that if you've traded in the markets for quite some time and you kind of get a sense of how crypto has usually moved in the past, it just hasn't felt right since then. I mean, maybe it's just maybe it's just conspiracies here or there, but I'm just curious so you think it's just all these factors, this confluence of all these factors at the same time: OG selling, quantum risk, top of the 4-year cycle, people getting out, no one stepping in, sailors slowing down.
I think those are the biggies. But if you ask me, is there a forced seller? So one of the theses is there are one or more forced sellers in the market. So there are firms that blew up on 1010 that are slowly unwinding their positions. We do know of some small hedge funds that had to do that. We saw the development with block fills it's very possible that there's maybe some offshore macro hedge funds unwinding complex Bitcoin trades that are forced sellers in the market. On the $10,000 down day, it certainly felt like that to a degree. So I'm actually not dismissive of the idea that there was a firm or multiple firms that blew up on 1010 and that have had to unwind, and that's created artificial selling pressure. I would just say that that wouldn't exist absent these other factors, right? It's like the environment created the potential for that to exist. And importantly, I think what will turn us around is not those people completing their unwind, right? That may remove like an upside cap, that may remove from some selling from the market, but I don't think it's the big dog in this. I think the big dog is, are people buying or are people selling? It's not one hedge fund in Hong Kong that's selling every rally or something. I think it's bigger. But of course, that can exist. We know it exists on a small scale. I wouldn't be surprised if it existed on a medium scale, and we just don't know the name yet. But I don't think it's like the big dog. It's the proximate signal maybe, but it's not the big force.
Got it. Yeah. So sometimes Occam's razor, it's not always the conspiracy on crypto Twitter that makes sense.
Yes.
So you noted in terms of this, your thesis, that retail hit max desperation and institutions are bullish. And however, retail historically leads the mania phase of the bull market. But many now say that they don't think retail is coming back. And indeed, you alluded to some of these points as to why they're not coming back. They've got other things to focus on, like AI and trading on zero day to expiry options, etc. So I'm curious, do you think retail is going to come back into crypto, at least to the extent it used to in the previous bull markets?
Yeah, it's a great question. Probably not until we're ripping to new all-time highs. I do think they're distracted by these other options. I think we're in more of a grind phase of the crypto market than we are the sort of hyperbolic up phase. I think there are lots of reasons to be bullish, but I do expect sort of the next crypto rally to be more grindy, more fundamental driven, more differentiation between good and bad projects, and more driven by sort of institutional and TradFi investors than traditional retail. I do think traditional retail is chasing this sparkly object, which right now is AI or sort of some prediction markets or more speculative areas of the market. So yeah, I think retail may in fact be gone for a little while as the primary driver of this market.
Yeah. And then in terms of the questions around the broader crypto complex in terms of assets, so retail has been the sector that has mostly been chasing after the altcoin gains and what has been driving a lot of the interest within altcoins. And there's a plethora of altcoins now, especially those that have launched recently. You've just got a dilution of so much a supply of altcoins on the market right now. And institutions, as you speak to them, are they considering investing in altcoins? I mean, beyond just ETH and Sol?
No.
No, straight up.
No, I mean, I wish I had a better story for you. There's a nuance to that, which I think is really important. I think they will in the near term, but they are just learning about the broad market, right? They have just learned maybe what Solana is, and they're learning what Chainlink is, and they're working their way down sort of the large cap coins. But if you go to a major institution and tell them about, I don't know, mega ETH, they're going to lose their mind. They can't process that at this phase. I will say there is starting to be one area where we do think there is sort of incipient institutional interest, which is the DeFi area. I think if you see things like Apollo buying Morpho tokens or BlackRock buying Uni tokens or the Aave will win proposal, and you look at those DeFi assets, which are really at very low valuations, right? Aave is what, a $2 billion token? Uni's a $3 billion token. Morpho's a $1 billion token. I do think because they're getting this buy-in from firms like Apollo and BlackRock, right? The biggest institutional investors in the world. I think there's a chance that we see some institutional interest in DeFi assets specifically coming out of this bear market cycle. But like the 18th L1, no chance. They just don't have time.
Yeah, unfortunate.
Yeah,
they've got some heavy bags there.
Yeah.
So I think that one of the biggest things that in terms of catalysts this year that people are alluding to is the long-suffering Clarity Act. And I mean, I was listening to the odds now, I believe, are like 50% or something that it's going to get done, but it's running against the wire. And, there's the end of March deadline. There's the banks pushing back. There's indeed something you mentioned in terms of the hesitance from the Democratic side to push forward any sort of legislation because of ethics questions. So I guess the first question is like, how likely, if you were to assign a probability to Clarity passing at all this year, where would you put it?
Yeah, if I had to buy one side of that poly market, I would take the it doesn't pass side. I wish that weren't true, and look, poly market probably knows better than I do, but I do think the Democrats are pretty dug in on the ethics concerns. For sure, Fair Shake has raised $200 million, and that's a big force, and they're afraid of that. But the ethics concerns, I think, could be the thing that derails this. So, yeah, I hope it's 50-50. I think it may be more like 40-60. So, yeah, I would fade that poly market if I was forced to choose, unfortunately.
Got it. Yeah, set your bets, guys. So just zooming out now, like a bit to the longer term perspective. And I think you'd mentioned previously in another podcast that you still think that a 10x is still possible in the crypto market cap in its aggregate. What time frame was that exactly?
Oh, I don't remember the time frame I put that in, but like we think Bitcoin can get to 1.3, $1.4 million in the next 10 years. And that's a 20x from here. So, I mean, roughly. So yeah, we think there's plenty. I mean, yeah, the next 5 to 10 years, there's an easy 10x in crypto. This is a huge market. We're reinventing money in finance. I think we forget that this is like one of the largest markets that anyone has ever gone after in the history of mankind. Money is a really big market. Finance is a really big market. I think crypto will disrupt all of that. So yeah, I think it's an easy 10x in the next 10 years. I think it may be significantly more than that, and may indeed come sooner than that.
Yep. I mean, one of the biggest concerns, though, one of the potential stumbling blocks for that could be something you've alluded to just before this, and that is the threat of quantum. And it's now got a lot of airtime. A lot of people are talking about it. And indeed, there are questions as to whether it has been one of the reasons of these OGs selling and other buyers not stepping in. Now, I'm curious, as someone who sits close to the institutional coalface, are the discussions you having, is this something that managers are actively concerned about?
Definitely. Yes, absolutely. The thing about quantum is if you're at a institutional investor, there's usually an investment committee. And let's say it's like 6 smart men and women who sit around and debate how the firm should allocate its capital. And all you need is one out of those 6 people to say, yeah, but what about this? And that can grind things to a halt for 3 months, for 6 months, for a year. And they don't say, yeah, but what about if you talk about large cap growth equities, right? No one is like, yeah, but no. But if you say Bitcoin and they say, yeah, but quantum, you can have good answers. You can say that the Bitcoin core dev community is now taking it seriously. You can talk about how it only threatens a certain amount of Bitcoin and not the entire protocol. But you don't have a clear way to completely push that aside. And so that yeah, but concern, it's absolutely keeping some institutions from allocating to Bitcoin specifically. Whether it should or not is a separate question, but it absolutely is, because all you need is that little concern, and it'll keep the conservative investment committee from being willing to make that jump.
Do you think that I mean, they have that concern because of the news flow, but based on your research and from what you're hearing in terms of the progression of quantum, do you think that that is a fair concern at least? And what's your timeline for this if nothing is done in terms of what you think?
Yeah, so look, I think it's a fair concern to say that the Bitcoin community is going to have difficult questions to answer around quantum. I think we can answer them. I don't think the core protocol is at risk. But I think if you look at the sort of Bitcoin that's lost in quantum exposed wallets, and you ask, how should Bitcoin deal with this? That is like a contentious question, right? Should it Should code be law? Should smart people be able to steal those Bitcoin? Should the community freeze those Bitcoin? Should there be some other technical hack that protects those? It is not. It is not. When you get to the tail end exposure, there's not like a super easy, super clean answer. So I do think it will be helpful when the community arrives at that answer, because that creates some risk. Do I worry about Bitcoin being broken by quantum? No. Do I think quantum will sort of detract from the long-term trajectory of Bitcoin and Bitcoin going to, $1.5 million a coin in the next 10 years? Absolutely not. I think that's fait accompli. I think that's driven by much bigger factors. I think that's bigger than quantum. But could there be like a significant moment of indigestion related specifically to quantum exposed wallets, and the community figuring out how to handle those things? Absolutely. There definitely could be. It's not an easy question. So I'm neither as worried about quantum as the people who shout quantum from the hilltops, nor as blasé as the people who are like, Bitcoin will figure it out. I think it's a challenging thing that the community is going to have to go through. And that indigestion, I think, is one of the reasons prices are down.
So do you think if the Bitcoin community successfully integrates BIP 360, do you believe that this would check the box for these institutional risk committees?
Yes. Yeah, absolutely. Even if it doesn't deal with the downstream element, the fact that the community has sort of focused on a solution and is moving toward that direction, I think would click the box. If I could go to an investment committee and say, the core devs are on this, the community is on this, it has a program to deal with this, and actually the bigger risk is your bank account, which is also quantum exposed. I think that's like a pretty good answer. And I think that would remove the yeah but concern. So yeah, I mean, one of the catalysts I think that will pull us out of this bear market, and I think there are many, and I think they are obvious to see. So there are some big catalysts coming down, but one of them will be the community, in fact, coalescing around how it's going to deal with quantum. And I think once it takes like the first major step, I think it'll be off the table from an institutional perspective. There'll still be people in crypto who worry about it, rightfully so. But I think for institutions, it won't be a blocker anymore.
Yeah, fair. Just playing a bit of devil's advocate when it comes to Bitcoin's narrative as a digital gold and in comparison to physical gold. Would this notion that, for example, in this case, where you'd have to implement improvement proposals to basically secure it from quantum, does this kind of high maintenance technology that needs to be done for as Bitcoin as an asset class rather than a passive monetary asset, does that not kind of counter to gold, which is a passive monetary asset? How does that play on Wall Street?
Yeah, I think people would worry about that if Bitcoin was as big as gold. If Bitcoin were the same size as gold, we could compare that and say, oh, it's immature. It doesn't have all these things perfectly figured out. But as it stands, Bitcoin is like, what, 6% of gold? It's tiny. It's a teenager or an infant or a toddler. Am I concerned that I have to teach my youngest son how to drive? I'm not concerned. He didn't wake up knowing how to drive. He's like emerging into an adult phase. And I think that's true of Bitcoin as well. So, you have to remember where Bitcoin is. Gold is what, $30+ trillion. Bitcoin is like hoping to be $2 or $3 trillion. It is a tiny fraction. So of course it's not going to be as mature as gold. It's also inherently digital. Gold just kind of sits there. Look, gold's physical fixed nature gives it some benefits. One benefit is it doesn't change. But Bitcoin's digital narrative or digital fact gives it benefits, right? A big benefit is you can send it anywhere around the world at the speed of light, and you can maintain custody for yourself through settlement. That's something you can't do with gold. So there are pros and cons to everything. The fact that it's digital means it has this negative, has to deal with things like quantum. But in exchange for that, you get to move it at the speed of light, stir infinite amounts in no space, and hold custody through settlement. I would make that trade. And I think the world will make that trade. So that's the way I think about it. You have to weigh both the pros and the cons.
Yeah, very well put. So moving on now to potentially, if we can look forward to the hope of pulling out of this crypto bear market, the forces that could potentially pull us out of that. This comes to one of your tweets recently, and you said that, quote, if you squint, you can see the forces that are going to pull us out. And you point to particular themes and narratives, and that is agentic finance, institutional DeFi, progress on quantum risk, as we mentioned, and accelerating tokenization. So of these four signals, which one do you think actually matters most for breaking the bear market, and why?
Oh man, great question. I think they'll all be helpful. I think when you come out of a bear market, you need a reason to make that turn. When I think about, I actually don't know which of those it will be. If I had to guess, the things that I'm most sure about being real are the rise of stablecoins, tokenization, and institutional DeFi. I actually have this little part of me that it thinks it may be this rise of institutional DeFi that get people over the hump. I mean, you're seeing incredible investments from the largest institutions into the DeFi space. There is a chance that that is it. But I do like the agentic finance story as well. If we think it's narrative and not fundamentals that bring us out of this bear market, I think that is a narrative that is emerging and real. But if you made me bet on it, it's the very real growth of tokenization, stable coins, and I would say institutional DeFi. I think that's maybe the trifecta that pulls us out of it.
Yeah, and on the institutional DeFi front, like the news you mentioned about BlackRock being tradable on the BlackRock Spittle being tradable on Uniswap, how big is that news in your view? I'm just curious because it is also kind of permission. So some DeFi, cypherpunks and adherents be like, well, that's permission DeFi, it's TradFi, kind of like.
So you can't go from 0 to 100. You have to go from 0 to 1. But if 100 means DeFi disrupts all of how finance works, then going from 0 to 1 is a really big deal because you're talking about a $10 trillion market cap. And the largest DeFi protocols are like $3 billion, right? So you asked recently, where is a 10x? Where is a 100x? Aave could be that. Uniswap could be that. Morpho could be that. Like the scale of opportunity versus the current valuation is so large. So it's absolutely true that what BlackRock is doing is permission DeFi, and it's only one single fund. It's also true that their CFO said they plan to tokenize all of their ETFs in the next 3 to 12 months. So within 3 to 12 months, you're talking about all of BlackRock ETFs being tokenized, which means in 24 months, all of their competitors' ETFs will be tokenized. And over time, I think you'll see that permissioned nature expand and break down. If I zoom out and look at DeFi, we've solved so many problems. We've solved a massive regulatory problem. We've solved a bandwidth and throughput problem, right? In DeFi summer, bandwidth was terrible. Now it's infinite. We've solved institutions understanding and being excited about it. We've proven that DeFi protocols work in extremely volatile markets. The last piece to unlock the $10 trillion opportunity is solving this question of permission versus unpermissioned DeFi, solving the question of AML, KYC, and sort of identity. But that's a solvable problem. So it's absolutely true. We're not going to go to $10 trillion tomorrow because it is still permissioned, but it's a huge first step. And the scale of opportunity is enormous. And honestly, the AML, KYC things don't seem impossible to solve. We still need some element of decentralized identity, but they're emerging good solutions there. For me, once we make this step, once BlackRock sort of endorses the idea of DeFi is important, which I think is what they're doing, it's really easy to see us solve this last hurdle. And I think the unlock there is just so massive, particularly when you look at the valuations, that it's pretty exciting to me.
And another theme and narrative you said there is agentic finance. So, obviously it was the news. I don't know if you saw the news last week about Stripe integrating X402 payments in conjunction with Coinbase. And this is the X402 protocol on Ethereum. So if you were to look out, let's say 5 years from now, how do you think the agentic finance space looks like?
Yeah, I mean, they're all using stablecoins, DeFi, and tokenized assets. Obviously, an AI agent isn't going to walk down to Chase and open an account by shaking someone's hand. That's just silly. So they're all using it. To me, the exciting thing about that actually is that the scale of it is so much bigger than people look at. I think a mistake people make when they evaluate crypto today is assuming that like the size of the payments market is going to be fixed for for the next 10 years, or the size of the securities market is going to be fixed for the next 10 years, or the number of transactions. The number of transactions could be 1,000x bigger than they are today, because AI agents can do things like micropayments. They can do 24/7 trading. They never stop. So I think people underestimate the sort of scale that AI agents coming into the financial system conveys for the number of transactions. Maybe an analogy is when we went from floor-based trading of stocks to digital trading of stocks, which is a transition we made in like the 90s and 2000s. The scale of trading of stocks just exploded, right? It's like 100x bigger, because it's much easier to type in a few numbers than it is to raise your hand and shake somebody's hand and write things down on paper, which is how we used to do it. Now we're taking that and making it agentic 24/7, 365 and global. It's another like couple log functions up in terms of the scale of the market. So I think agentic finance will be enormous. I think they'll be using exclusively crypto-based rails. And I think the size of the market is like 10 or 100x bigger than we're thinking today, because we haven't adapted to what that framework means.
Yeah, and of course, as using stablecoins, the demand for stablecoins is going to skyrocket. So those two working together to drive demand for those two narratives. Speaking of AI now, I just want to move on to the broader AI markets right now as an investment theme, and this has completely reshaped our world. And there's been a lot of debate of it as a bit of a disruptor, and that is indeed true. But the massive AI spending is also having a drag on equity valuations. You've seen a lot of the AI best performers last year have been very soft this year. So where do you stand on the AI trade right now in the broader equity markets?
Oh, it's a great question. I'm generally optimistic on both, at least for the next couple of years. I have a strong feeling that the AI sort of data center build out will do what every infrastructure build out does, which is overshoot. So eventually we'll build out more capacity, just like we did in blockchains, where we built out too much capacity on layer ones, just like we did in the internet, just like we did in railways, et cetera. The natural response to a shortage is to create a glut. And I think we'll create a glut, but I don't think we're there yet, because the pace of growth on AI is so positive. So I think it's probably like a few years forward, we should worry about there being a bubble. For now, I'm pretty optimistic generally. Look, GDP is growing well globally. I think there are real benefits to companies from AI. We're certainly getting a lot of lift at Bitwise. I think it'll have disruptive effects for society. I think it will sort of cap or flatline job growth. But I think the outlook for equities generally is probably pretty good over the next like 2 years. There'll be disruption. There'll be companies that are fundamentally set back because of AI. But generally speaking, I think the growth will be pretty good. I mean, that's what you see when you look past all the noise and look at the data and look at earnings and GDP growth and employment numbers. All of those actually look pretty great. So I'm not as worried about the sort of near-term fallout as maybe some other people are.
And even at so the raise and the size of the raises that some of these AI companies are doing in terms of capex, but also in the debt markets as well. I think many people point to that as potential concerns around, like, if this capex and this AI spend really can justify at the end the revenue that may come in. But I think the main argument being made is, look, they're racing. It's obviously of geopolitical and strategic importance to get to AGI first amongst globally. Do you have a sense of when we could potentially, any sort of sense of when we could see AGI? I mean, I know it's as hard trying to also estimate this quantum threat itself in terms of AGI as a big concept, but I'm just curious if you have a thought to that.
Yeah, for sure. Look, I think, I don't have that much expertise in here. I have a little bit. I'm on the board of an AI-driven investing company, manages like $7 billion in assets. So I've been following the space pretty closely. I think it'll be rolling. I think it'll depend on which area you're in. Arguably, we're already there in sort of software coding. We're at AGI levels there. Is it general intelligence? Is it like people have raised the idea of AGI being, the best human in every field in one computer. Are we there yet? No. But I think the direction of travel is there. I also, I'm of the view that there's no real cap. I think a lot of people assume the growth is asymptotic, that it can only sort of reach human level intelligence. I think that's a misunderstanding of how the systems work. I expect it to sort of blow past us in many ways, which I'm looking forward to. It would be great.
Optimistic, not the Skynet scenario, the benevolent AI is going to help us scenario.
Yeah, I mean, you have to look at. I think you have to take a Bayesian approach to it and look at all other technologies, including thinking technologies, and think about what they've done for us. Right? Like I use Excel all the time. It's much better at math than I am. It's probably degraded my ability to do math, but it's been a great service for me in letting me do new things. The same thing has been true in AI from my experience. So no, I don't worry about the bots taking over. I mostly think this will be hugely beneficial.
You say you're on a board of an AI investment company, and I know you're very much focused in the crypto space, but I'm curious in terms of AI and asset allocation within the AI narrative and investments, are you thinking about what sort of companies or potential metas you would suggest if you were investing in the space? What should people be looking at if they still want to get exposure to the AI meta?
Yeah, it's really challenging. I mean, just to be clear, the AI company I'm on uses AI to make investments in the market. But in terms of the big challenge there is most of the most exciting investments are private. I think the key to me is you want to be invested in the market. I think now is probably not a good time to have idle assets, even with valuations as high as they are. I just think the scale of capital creation is really significant. So I don't think the publicly traded AI ETFs are a bad place to start. I think they have a place in people's portfolios. And then to the extent that you can get some private exposure, just have as a portion of your portfolio, if it's as big as important as it can be. I think that's a big deal. But look, I'm optimistic on the broad equity market. I think it's a great tool. I think you're going to see productivity growth really increase. And there will be winners and there will be losers, but I think the winners will win more than the losers will lose. And I think the value will accrue. So generally speaking, just make sure you're investing in the market. I think they're boom times ahead of us.
Yeah, indeed. Well, one of the more important factors now shaping current markets is what's going on with the macro. And we've had a turbulent past year. So, tariff threats, the collapse in dollar, volatile uncertainty at the Fed. But it seems we could be getting some certainty now around, Fed policy with incoming Kevin Warsh. So I'm just curious, Matt, how are you reading the macro tea leaves at the moment?
Yeah, I think it's a good question. Look, I think there's some things that for sure, right? We are moving into a multipolar world with multiple, the sort of dollar's hegemony over reserve currency status is fracturing a bit. That's in every piece of data. It's a long-term trend. I'm not saying it's good or bad. It's just factually where we're going. From a US macro perspective, it's pretty obvious to me that Warsh is strongly of the view that AI productivity gains allow us to lower rates, even despite strong economic growth. So I think you should be betting on lower interest rates despite high economic growth. He wants to constrain the balance sheet. He wants to rein in sort of the Fed's expansive balance sheet. That would typically be bad for crypto. I think the argument crypto would make is that he'll be constrained in his ability to do that. And so maybe the rate cutting will be easier to do than the balance sheet constraint. I think Lynn Alden is right. Basically, nothing stops this train. We seem to be printing more and more debt over time. The Treasury is going to be facing down that challenge. So broadly speaking, I think the macro is pretty good for crypto specifically. I think there is more debt and debasement. And I think concerns over sort of Fed balance sheet shrinkage are probably overstated. And the ability to cut interest rates is understated. So I'm optimistic from that perspective. And then more broadly for the economy, look, the economy wants to run hot right now, and the political leaders want it to run hot right now. And so I think it will run hot right now. I don't know if that will be like stable long term, but I think over the next year or two, you have to expect like pretty good GDP prints, pretty good economic growth. That seems to be what's in the data. So I don't. I guess I'm pretty optimistic from a macro perspective. Not ragingly optimistic, but pretty optimistic.
Yeah, indeed. And I think that you're right in the sense that the market may have freaked out a bit too much around Kevin Warsh's hawkish stance, because I think that his background as well. I mean, he's obviously worked there with Stan Druckenmiller, who also coincidentally worked with Scott Bessent, and they're going to kind of like synchronize their actions in terms of how impact on liquidity and balance sheets, and also now this concept potentially of like fiscal liquidity coming through the treasury, right? How do you view that in terms of the dance that's now going to be done between the treasury and the Fed around liquidity in the markets, as now they're basically working in conjunction with each other?
Yeah, I think that's exactly right, and I think Warsh is probably right to put that on the Treasury, right? I think that's the right way to view the economy. I do think the Fed has gone off piste. It's sort of stepped out of its traditional role after the great financial crisis, and then instead of pivoting back, it just kept going down that road to the point now it has trillions of dollars on its balance sheet. So I think what Warsh is doing is actually good for how the Fed should work. On the Treasury side, they're just stuck, right? There is just so much debt, and we can't have, at least the short-term debt, which is where we're refinancing it, we can't have those prices ratchet up. So they have to find a way to support that market. Otherwise, there'll be dislocation. So I think they're sort of in a pinch where they have to do it. I think Warsh is right for how it should be structured, with the Treasury being responsible for it. But even if they wanted to shrink the balance sheet, I just don't know that they have the ability to do that without the bond market freaking out. There's sort of no reason to assume they could. So I think they're in the pinch. I do think it's how it should work, and I think that's how it will ultimately work. For what it's worth, I think the Kevin Warsh freak out should be put in perspective, because I actually think what the freak out was about was that it was between Warsh and Hassett, and it was about even in the poly markets, and Hassett was going to print us to the moon. I think if we had had Hassett, Bitcoin would probably already be at new all-time highs. So I think what the market was calibrating was like, it's 50-50 between print to the moon and a more rational Fed policy. And we got more rational Fed policy. But that delta is actually the freak out. It's not that Warsh was like super hawkish. I think it's the delta between Hassett and Warsh that is what caused a catalyst for the downtick in the market.
I'm curious though, in terms of like a lot of emphasis being put on the Fed chair himself, indeed, and also the fact that Trump has been pressuring Powell on interest rates and all that. But the Fed policy is determined by the FOMC, and I'm curious in terms of like, do you think that the markets are putting too much weight on the individual being Kevin Warsh versus how the other members of the FOMC should decide on policy? I mean, because in the past, there was generally a view that the rest of the FOMC committee would kind of follow the consensus given by the chair. But now it seems to be a lot more disagreement between the members of the FOMC. So do you think that that's something that the market should be thinking about more broadly, is not just about Warsh's policies, but what the other members are thinking?
Oh, that's a good question. We've certainly seen a little bit more dissent than we have in the past, sort of back to the way the Fed used to work, sort of in the early Greenspan era. I think that's healthy for what it's worth. Look, generally speaking, I still think the chair sets the agenda, and I think Warsh is very respected and will be good at aligning the rest of the committee with where he wants the market to go. So, could we see some dissents? Maybe. But most of the dissents, for what it's worth, has been on the sort of Trump view of massively cutting interest rates. It's been Moran, it's been Waller. It hasn't been people wanting to raise interest rates as much. So I mostly think it will be a Kevin Warsh Fed. Yes, there'll be more dissent, but I do think he'll be the big dog, and I think he'll be effective at guiding rates lower.
Yeah, I think he is very well respected, not just among his peers, but also on Wall Street and all that. So just moving on to something in terms of your personal experience, Matt, and a recurring theme in your work is this tension between long-term conviction and short-term survival, especially in like volatile, illiquid assets like crypto. So how do you personally think about these trade-offs as a CIO?
Yeah, well, I think it's a good point, and crypto is enormously volatile. I think it's from an investment perspective, I think the answer is simple, which is just don't take on leverage and debt. If you don't have leverage or debt, then these pullbacks are not a big deal. You just ride them out as long as you have long-term conviction. So I guess the answer from a CIO perspective is understand why you have long-term conviction. Understand what could change that, what would make you sort of truly want to re-underwrite the investment category and think that maybe you have it wrong. So don't be dogmatic in your approach. And then don't take on leverage or debt. It's leverage and debt that blows you up at times like this. If you're not levered and you don't have debt, then who cares, right? Bitcoin is still going to $1.5 million in the next 10 years. That's a massive return. It's better you can get in any other asset class. This is an opportunity to add more, or at the very least sit tight. So yeah, avoid leverage and debt. Understand your long-term thesis and what could cause it to change, and periodically re-underwrite it. And I think if you do those things, look, the market is pretty good. People always make fun of me for being optimistic. I joined Bitwise when Bitcoin was around $8,000 and it's $70,000 now. That's pretty good. Has it been volatile in between? Absolutely, but it's been pretty good. If I'm here for another 8 years, God willing, I think it'll be up another, 10 to 15x. That'll be pretty good. So you have to have that long-term perspective. And then if you don't have leverage and debt, you can just ride it out and wait.
Can you give a personal example of a moment where that tension was real for you, where the long-term thesis still made sense, but the short-term environment forced you to adjust, like sizing, timing, or exposure?
Oh, yeah. Well, I mean, there've been some really challenging moments for sure. So there've been moments where that question of that long-term thesis had to be addressed or considered. Certainly in the worst of the FTX crisis, I didn't buy more Bitcoin, even when it fell down to very low levels. And the reason was that felt to some degree existential. You had sort of a collapsing market structure, and you had a regulator that objectively hated and wanted to kill crypto. And so I think at that moment, there was a non-zero chance that crypto just got crushed, and was crushed for like 10 years. And so did I miss the opportunity to buy it like 5,000 or 3,000 or whatever it got down to then? Absolutely, I did. And that's an example of where you have to be realistic about what's going on in the market. If the US regulator wanted to destroy crypto entirely, which they did, and you had the world's largest Ponzi scheme and then a cascade of liquidation, that's a pretty existential event. Do I wish in hindsight I'd gone back and bought more? For sure. But I think that was a realistic assessment where you have to be like, look, the short term is a mess. We're not going V-shaped. We need a regulatory change. We need to wash all this nonsense out. For what, I don't feel like that in this market. This market doesn't feel existential in the same way, but I think crypto faced an existential threat back then. I would add even the 2018, 2019 bear market had more concerns. It wasn't as existential as that. But that FTX example is a good example where you have to re-underwrite the long-term thesis, and the short term sort of dictates what you can do.
Yeah, that was really some really dark times indeed. So, if you've been through that and you hear this is child's play.
So true.
Yeah, I mean, there's many people who say, "No, this is worse. This is worse now than FTX and all that." But I guess it's just recency bias, right? I mean, go back and put yourself in that time, and you realize, yeah, it was kind of existential.
It's complete nonsense to say this is worse than FTX. It's not even nearly as bad as 2018, 2019. I tweeted about this earlier. 2018, 2019, if you remember, Bitcoin fell from 17 to 5 and then treaded water and then fell to 3. And no one was interested. And there were no other applications. You had Bitcoin and Ethereum, which could handle like one transaction a minute, and prices would spike to $200. It was a very dark period then as well. So this is, child's play for sure, right? If you look at it now, we have stablecoins going to $3 trillion. We have tokenization going to $200 trillion. We have BlackRock, Apollo, and others building in crypto. It's actually pretty good compared to those two bear markets.
Yeah, good point, man. So obviously now being one of the best known crypto CIOs, and as a result, you may have many perspectives on the ideal portfolio for a person getting involved right now in crypto. So for our viewers watching and thinking about asset allocation, how would you think about structuring a portfolio? Of course, not financial advice, But I mean, you can include crypto in there and other asset classes as well. How would you think about that distribution?
Yeah. Well, let's start. Can I give you three different views? Because I think it depends on what kind of person you are. Let's say you're someone who doesn't care about crypto at all. You have no opinion, positive or negative. You haven't spent any time on it. You don't really care about investing. If that's you, you want to do what Jack Bogle, the founder of Vanguard, said, which is just own the market. The interesting thing about just owning the market is you want to own all global stocks, all global bonds, and you want to own crypto because crypto is part of the market. If you look at the relative market cap of stocks and bonds and crypto, you need to have about 1%, 1 to 2% of your portfolio in crypto. That's the starting point if you're neutral. So I think a lot of investors are at zero. That's actually mean you're missing part of the market. The sort of classic Jack Bogle asset allocation would be about 1% crypto, 60% stocks, and 39% bonds. That's like your starting point. Okay. What if you're relatively like somewhat optimistic about crypto? It's been the best performing asset class of all time. It has huge growth behind it in terms of stablecoins, tokenization, worries about fiat currency. It has the largest institutions in the world starting to build on this space. Then I think you get the right allocation for crypto is somewhere in the 2.5% to 5% range. And the reason for that is if you're not highly convicted, crypto is very volatile. And the biggest risk for you is you get shaken out in these bear markets. If you have as much of your money in crypto as I do, then these bear markets are very painful and you might panic and sell at the bottom. If you have 5% of your portfolio in crypto, historically, that's driven a huge increase in your risk adjusted returns. And you can ride out these bear markets. So for someone who's like mildly optimistic, I think 5% is in the right range. And then if you're like me, you can have much more. And you want your portfolio to be future proofed against where the market is going. That means having some exposure to the growth in AI. That means having some exposure to the growth in biotech, which I think is sort of the forgotten area of massive disruption in the market. It has some exposure to crypto. I have a lot of my personal wealth in crypto, but that's for the highly convicted investors. But even for those, because we're on a crypto podcast, I will say you still want exposure to equities. You still probably want some exposure to at least a money market fund for a good enough portion of your wealth that you don't have to panic if you lose your primary source of income. So you need some cash, you need some equities, you need some crypto, you need AI. I think you need biotech as well. That's where I would look. So pick your fighter between those three. But I think
of course, it's personalized, depends on people, also people's risk preferences and their
totally.
timeline and all that. Curious though, in terms of you personally, then as a crypto native and you work within the industry, how much of your personal portfolio is in crypto compared to the other
Personal liquid portfolio is something like 30 plus% at this point. That's outside of sort of my shares in Bitwise and outside of my career being in crypto. So of the liquid net worth, it's somewhere in that 30% range.
Yeah, I mean that makes sense, man. If you work in crypto, your whole job is attached to crypto and everything. If you have a full portfolio in crypto, that is but too overexposed. So that's fair. Well, thank you, Matt. I mean, I really enjoyed this conversation. It's given me a renewed optimism in crypto in the space, and it just means that we have to make sure to get you on again when we have in one of these deep bear market identity crisis to give us a perspective on Bitcoin is going to 1 million. Just keep it calm and hodl on. Get some
That's
allocation to it, guys, and the future is bright.
That's exactly right. Thanks for having me. This was a lot of fun.
Great. Thanks, guys. Cheers.